My name is John Mayo. I am a professor of economics, business, and public policy here in the McDonough School of Business, which is where you are in the Lohrfink Hariri building, named after the former Prime Minister of Lebanon. I know some of you have traveled a long way to get here, and we really especially appreciate your efforts to make the trip. You may or may not have had an opportunity to be on the Georgetown campus before. Let me say, for those of you who do not know Georgetown University, that is a very old and we believe distinguished university, old by at least U.S. standards. It's a university that was founded in 1789, and if you'll get a chance sometime, not out of the, to move away from the sessions, but if you take an opportunity at a break or at some other time to walk around campus, it's a lovely campus. If you walk over to the older part of the campus, let me encourage you to stop by a small quadrangle called Dahlgren Quadrangle. And Dahlgren Quadrangle has on one of its sides a building called Old North, which is very, very historic, that has had a series of United States presidents speak from that building and from a podium that you'll see, a platform that you'll see over there, beginning with George Washington, who's addressed the student body in 1790. President Abraham Lincoln addressed the student body in the 1860s, and a tradition of presidents have spoken here and there up to the modern presidents of Bill Clinton, and most recently President Obama did a major address on global climate change in Dahlgren Quadrangle. So let me just encourage you to take advantage of what looks like it might be a nice spring day and get out and do that. We need spring days around here. Aside from my role as a professor, I'm also the executive director of the Georgetown Center for Business and Public Policy. The purpose of the Georgetown Center is to examine issues that lie at the nexus of business and public policy and to accelerate debate and discussion and dialogue at that intersection. So you might imagine how excited we were when we had the opportunity to partner with the World Bank on this conference on doing business, because I really cannot imagine, for those of you who are researchers in this area, I think you will share this opinion, I can't imagine a better lens into this particular intersection for economists who are seriously interested in understanding the role of public policy on business, on economic outcomes of business, and the other way around, the role of business in influencing public policy. I can't imagine a better social science instrument than the Doing Business Indicator. So we are delighted about the opportunity to host this conference. As you will see from the agenda, it's a terrific set of papers. It's a terrific set of speakers. We're very, very excited to have you here. If there is anything that the folks here at Georgetown can do to make you feel more welcome, please don't hesitate to let me or any of the staff know. And with that, let me turn to our first substantive speaker, Kaushik Basu, who is the chief economist at the World Bank and senior vice president. He is a former chief economist and advisor to the government of India. He is a chaired professor at Cornell University, a very distinguished scholar, and we are very, very happy to have him offer some welcoming remarks and some opening remarks. Kaushik?
John, thank you very much for those generous words. I'm very pleased to be here. This is an area, doing business, the importance of business ethos, for which I used to be a user. And little did I imagine that I would be on the other side where a lot of this work is being done and findings being put out. My user interest, to tell you first, it began many years ago, actually, when the World Bank started the Doing Business reports. Within the first 1 or 2 years, I used the report to write an article, a popular article, on the nuts and bolts of an economy, not about the fiscal policy, about the money you're injecting into the economy. All those are important, but the nuts and bolts can also be very important, is the argument I was making, and I made use of the doing business numbers being put out. And as illustration, I talked about something that Michael Kramer at Harvard had written about, which is the importance of the O-ring. If you remember the dreadful disaster, the Challenger disaster that took place. First, one looked for big causes as to why such a big thing blew up. And in the end, it was discovered that it's something which I still don't understand, the technology. It's a tiny, literally something like a ring, joining two parts of it, which could not take the temperature to which it had to take. And that blew up, and the entire spacecraft blew up as a consequence of that, to emphasize the importance of the nuts and bolts of a society. Subsequently, when I was with the government of India, which John just referred to, I began actually using this, and there were some very important reports of the government of India. The most important report, the annual Economic Survey of India, which made use of this actually several times on several occasions, and I'll quote you in one place, and I'm coming to some criticisms of the doing business and how we do, but let me first of all read out just a line from the Economic Survey of India in 2009, which says the number of days it takes in India to enforce a contract is 1,420. It can no longer be argued that this is inevitable given the complexity of contracts, because now we know it takes 150 days for the same in Singapore, 300 days in the US, and 406 days in China. The advantage of a good report, a cross-country report, is it gives the country exactly that leverage. It's very easy for political leaders, even the policymakers in a country, if you make a hand-waving reference to the bureaucratic costs, they will give you a hand-waving response saying that, it is everywhere, it's like this. But once you have systematic cross-country data, with all its difficulties and faults, it is a very, very powerful instrument. And so this is being used in many countries, and I really believe that it's an extremely important work that comes out of the World Bank and gets used. And I'm actually, again, I have to thank all of you for hosting this conference, to the School of Business here certainly, and to my colleagues at the bank, Augusto, Melissa, Rita, and others for doing this. It's worth stopping, doing a little bit of stock taking of where we stand. Let me now switch over to the other side. Little did I know when I was using that within a couple of years, I would be actually seeing the production of this. And there's this saying about sausage making or something that you shouldn't see it being produced because then you'll hesitate to eat. There is a little bit of that. And let me explain that what happened when you switch over to the other side is many of those things you take at blanket value, that these are the numbers coming out, you begin to use those numbers if you're just looking at those numbers. Once you see the production, you realize what at one level anyone should realize, that when you're doing cross-country studies, there are rules of thumb you have to use which don't apply very well to one region, applies extremely well to another region, but you have to use common standards, and there is the problem of then settling on one standard. And that is unsettling, I have to say, when you see this, and I do believe that that modesty should be there with studies of this kind, warning people that there are these problems. On the other side, on the other hand, I also saw the sheer sincerity of purpose that goes into this. And there is a full transparency. You know what is being done. You may at times feel that what is being done is not quite right, but it's all being laid out very, very clearly. And now that I've sat and had many sessions, it's just very impressive, the sincerity and the sense of purpose that the team, World Bank team, has been putting into this exercise. Where do we go from here? And I'm hoping that during these 2 days, there will be lots of ideas that will get exchanged, and we will have steps to take which will make this a better product and will contribute actually to society at large. The plan, I should tell you, the World Bank's plan is that we will use about 2 years. You probably know that this has moved over from one part of the bank to the Development Economics Unit, DEC. And this is an occasion, and there was this very important report, the Trevor Manuel Committee report, which drew our attention to aspects of this report where we could improve on this. So our plan is to use about 2 years. It's a major enterprise to try to improve this. So this is really the time to get new ideas on the table and try to make as many improvements as possible. One of the reasons for limiting the duration over which you make improvements is that with data like this, there is cross-country comparison going on, but there is also intertemporal comparison going on. If you make too many changes at too many points of time, the intertemporal part of the exercise gets troubled and destroyed. I mean, you can't make use of that. So we will make changes, but we will do it over a short duration and hopefully have an improved product coming out after that and hold it more or less constant with some other small changes coming in, of course, improvements as we go along. What are the kinds of changes that we are planning? Let me just very briefly mention one thing, and I will, that we do want to expand the cities in which this work is done. One criticism that we were getting, and the committee report, the evaluation report, draws our attention to this, is that China is being studied through one city, India through one city, Russia through one city, and there is a bit of a feeling of discomfort given the variation. I know that once there was a subnational study of India where there were at least 17 cities that were studied, and the variation is quite large. So we are going to expand that. But I want to take advantage of this relatively more academic gathering to draw your attention to one or two relatively conceptual matters over here, which I think we ought to collectively keep in mind. First of all, some criticisms which have been coming, and I want to dispel that those are not valid criticisms. One criticism that after I took on, and this is, as you probably know, it's a politically very charged area. One criticism that comes is people will point to countries doing very well on some indicators and then say, look, on doing business, the country is not doing so well. So that people will say that, look, this country grows so fast and it does not do well in terms of doing business. Now, doing business is not a measure of growth. If you want the perfect measure of growth, you should look at growth, because there is a perfect measure of growth, which is to look at growth itself. Doing business is one of the components of that. If it actually correlated perfectly with growth, it would be uninteresting. It is just one component. Likewise, people will point out foreign direct investment flows so well into these countries, and not all of them do well in terms of doing business. But there are many reasons why foreign direct investment can flow very well into into countries. Crony capitalism is excellent for attracting foreign business. It'll be from a few well-connected businesses that will flow into the country, and we've got lots of historical experiences of a country that will be crony capitalism, will build up relation, and then capital will flow in, and in the long run, you run into grief. We don't want to give tribute to that kind of FDI flows. There are FDI flows that can take place for very important good reasons, which have very little to do with doing business. A country that manages its fiscal policy very well usually gets more foreign direct investment come in. We are not even looking at that. We are looking at one component, very important component, the nuts and bolts of business. And that is what doing business does. And we want to do it as well as we can. There are a couple of changes that we are doing, and again, since it's a relatively academic group, let me explain some of these to you. There are certain indicators where if you look at one end of it, you feel that you know the direction in which it's bad and the direction in which it is good. If you take tax rates, start from a moderate tax rate and go to higher and higher and extremely high tax rates. You know, in India, income tax rates in the, I'm forgetting now, in the late 1970s, income tax rates would be higher than 90%, the marginal top rate, had gone to crazy levels. If you look at that, then you tend to reach the conclusion that the higher the better, higher the worse for business when this rate continues to rise. It's very easy to flip it around and say, therefore, the lower the better, and treat it as one line. But if you think a little bit, There are many things that the government has to do. So it's not a monotonic relationship, that there is a point beyond which it begins to hurt the tax rates. Likewise, when it goes very low, that also can hurt. So it's not a nonlinear transformation of an important indicator into goodness. It's not a linear transformation. You have to allow for non-linearities on this. Very, very controversial topic, and I've been in many discussions on this in India, on labor regulations. And fortunately, the World Development Report on jobs draws our attention to this, that again, the regulation and goodness don't go in one direction. In fact, the World Development Report, very importantly, presents the idea of a plateau, that yes, you can have excessive regulation which strangles business, hurts employment, but you can also have so little that you can do a lot of damage to the very business ethos of the country. So again, it's not a linear relation. You have to bring this in, a particular mechanical indicator to goodness and badness. The transformation has to be done intelligently. Now, I'm going to end by taking one particular topic and show you the difficulty. This is not something that we deal with directly, but that you have to have your conceptual antennas open, and this I'm saying since I see lots of people from the World Bank team over here. Over and above the sincerity with which we are doing our data analysis, data gathering, we have to also have our antennas open to the analytics of these things. You know, Tim is sitting over here. Tim has a work on with Robin Burgess, very influential work actually on labor laws in India, which exploits something very interesting in India's labor regulation. The Indian labor law takes the following form. The main labor law is at the federal level, at the national level, but in some laws in India are supposed to be called the concurrent list. The Indian Constitution allows states to amend these laws. So the labor law, Industrial Disputes Act, is on the concurrent list, which means states can amend them. So you get this big country with, over the years, states having amended this law in different directions. And you can see how job creation has happened in different states with this. And what this paper throws up is actually the set of paradoxes. Many moves which are treated as pro-labor moves undertaken legislatively actually turn out to be in some ways anti-labor. You don't get more employment. This does not mean that you immediately jump to conclusion and you say whatever is called pro-labor in the Indian legislation is anti-labor. It just alerts you to the fact that this is a very, very complex topic. And I'll give you one almost technical example, but completely in words, to just alert you to the difficulties of this venture and the seriousness of this venture. You have to be on alert as you go into this. This is an ancient debate. You don't see this take place anymore. It happened in Britain over many years. This was debated, and I'm sure it's happened in other countries, also industrialized countries. Hours of work. Do you limit the number of hours that people work, or don't you limit that? If you take a very mechanical neoclassical economics hat on, and I say mechanical because there are lots of intelligent neoclassical people who would not do that, they will say, no, why regulate a number of hours work? If someone wants to work 18 hours and drop dead at the end of that, and someone wants to pay this person for 18 hours of work, you should allow that to happen. And that used to happen in Britain 200 years ago, 250 years ago, when people would be working 15, 16 hours, very low hourly wage rate, but they would do that. They would prefer to do that, and there was this argument that you should allow. This is the market working out. There are some difficult areas where I take that line that when the market gives you that signal, you have to take those hard decisions. But here, what was realized is a somewhat analytical point, but it's worth being understanding this. When hourly wage rate is very low, people want to work many hours because they want to survive. They need that for their bread and butter, and they work. There's a glut of labor available, everyone trying to work a lot, and the hourly wage rate remains very low. If you have a legislation which says that, no, you can't work your workers more than 10 hours a day, or whatever, you place a limit, that forces people to pull their labor out because you're not allowed to work more than that. When that supply of labor is pulled out from the labor market, the wage rate, hourly wage rate rises because there are fewer of them looking for work. And it's entirely possible that the wage rate will rise to a level where if the wage rate was there, people wouldn't have worked for more than 10 hours anyway, because at that hourly wage rate, 10 hours or 8 hours work is enough. They are getting to meet the ends that they were after. So what the legislation does over here is flips that equilibrium that you are caught in to a better equilibrium where the hourly wage rate rises, and then actually you don't need legislation after that because no one wants to work more than that once the wage rate rises to that level. So regulations can have a role which actually can be pro-labor, where you restrict certain kinds of activities which both sides agree. But you have to be careful about this. It's very easy also to put on your intrusive hat, and I've seen that. I've worked in governments where you try to interfere everywhere. All this goes to show that this is a difficult area of great intellectual interest, but also huge practical implications. The trouble is, unlike in the research, you don't have endless time to wait and sort it out before you begin to put out the data. Just after I joined the government of India, I got a note from the finance minister saying that he wanted to know futures markets, if it is allowed, what that will do to grain prices and welfare. I got that question. I had just joined government, and I was thinking, now I'll take the next couple of months to work on this. When I sent back a note saying, how soon do you want the response to this? And I got a note back again saying, can I have an answer in 48 hours? I remember I wrote to my colleagues at Cornell saying that, I have to respond in 48 hours about the goodness or badness of futures markets, and I want to give a serious answer. That didn't help too much because they sent back references to Journal of Economic Theory, papers that were there, and I would not be able to ingest that in 48 hours. But this is, of course, when you're out there making policy, this is the compromise that is involved. So I'm just laying out for you the difficulties, the challenges, the importance of this work. Once again, thank you very much to the School of Business for organizing this conference, my colleagues at Georgetown University for hosting this. Thank you very much. Well, I'm stepping in just to invite Tim Besley to give his talk. Tim, welcome. Yeah. Tim was a part of the manual commission report that I was talking about.
Well, thank you, Kaushik, and thanks to the organizers for inviting me. As Kaushik just mentioned, my life has intersected in a variety of ways with the Doing Business project over the years, both initially as an outsider looking in on this project as it was beginning to be developed at the bank and seeing how its influence was developing. Then actually as a member of the Indicators Advisory Group of the project, and ultimately I was asked to be a member of the Manual Commission and therefore contributed to the report that was published last year. And in fact I was scheduled to participate, as I imagine a number of you were, in the 10th year anniversary conference that was subsequently rescheduled, and I believe this is, although it's at 11 and a half years, is in effect the 10th year anniversary conference of the Doing Business project. And it's a wonderful opportunity to participate in the discussion of where this project is and some of the issues that have arisen, both in the context of seeing the project develop, but also standing back and looking more generally at what's been achieved via the project. Now, I've got to figure out the technology here. I'm going to guess that if I do that, no, that didn't work. Let's try that. Oops, no, that didn't work either. Someone's going to have to show me how to use, oh, wait a minute, what about that? There we go. Okay, so I'm going to have to look back here in order to look at my own slides because there isn't anything showing on there. Okay, I chose deliberately to begin this presentation by stepping back and asking a more general question. What is the validity of, or the case for, collecting and trying to benchmark the business climate across countries. And I should also say, actually, for those of you who are listening to this, I'd be very grateful for your input and ideas, because I'm planning to write a piece for the Journal of Economic Perspectives following on this. So this is an evolving set of thoughts, which hopefully will eventually appear in print. And I think it's fair to say there's a dual purpose here. There's one that I think was uppermost in the minds of those who I think were first involved in the Doing Business project, which was to influence policy. But indirectly, whether they liked it or not, but given who was involved, it wasn't so surprising. There was also the desire to influence research and to allow people to look at the world through the lens of the Doing Business project. So there are both policy and research gains, potentially, from trying to collect internationally comparable measures on the business climate. And of course, the aim is to overtly to inform and to influence policymakers. And I'll come, as I speak, to different ways in which we think about that process. Of course, for researchers, the question that immediately arises once one has got access to a set of comparable measures is, are they in any way related to, correlated with, whatever methods you choose to use, measures of good economic performance, whatever you choose to be your metric of good performance. And that, of course, has been debated at length. Now, one thing I should say, and this is not an unusual area, economists are conveniently schizophrenic when it comes to any exercise like this, in sometimes wanting to put the variables on the left-hand side of regressions and explain which countries have better business climates, and other times want to put these indicators on the right-hand side of regressions to explain what it is about having a better business climate achieved. So these variables have been used in both ways, both to explain outcomes and as things that people are interested in explaining in their own right. Now, it's not unusual for an international organization like the World Bank to be engaged in the business of trying to produce internationally comparable data. We can think of many organizations that have influenced policy, I think, through the way they've collected and published data. And I just cite two examples. Amnesty International's data on human rights are heavily used in the policy debate around what's going on in a number of countries. Equally, Transparency International's work on corruption are just two examples of data collection exercises that are specifically, I think, aimed at furthering the mission of the organizations that collect them. And of course, they ally very naturally to the mission and the advocacy role of those organizations. Now, there are other data, I think, internationally comparable data, where it's less clearly linked to what you might call a well-defined mission. I'm thinking particularly of data on Polity 4 on democracy. As far as I know, those who collect those data, they're widely used and widely looked at, and actually they're also correlated frequently with the Doing Business indicators. But that project is what I would call a pure research project. I mean, although I think those who produce the data probably do have some attachment to some kinds of democratic values, that is not the purpose of the project, to further and promote democracy around the world. Equally, the PRIO project on civil war, which has been a very important international project, equally I don't think is based explicitly on trying to change the course of history. So there's nothing conceptually unusual to imagine a world in which an international organization decides that it's going to pursue the collection of indicators of the business climate. And we know that lots of private firms are doing this. They do it alongside what the World Bank is doing. I'm sure they use, to some extent, what the World Bank is doing in the Doing Business project as part of what they do. But you can go out, if you're a large corporation or even a small corporation and you wish to go and invest around the world, very often you'll take advice from one or more organizations that produce some kind of assessment of the business climate in different countries as a way of trying to decide where to direct your investment. And those have a market price, of course. Before the financial crisis, we used to think that having a market price was necessarily indicative of value, but we have to be a little cautious in saying this has value. But people are willing to pay, and so I think that whatever advice they're buying through this is something that they deem valuable in terms of their business practices. But of course, the World Bank views data in this context as a public good. It puts the data out there very much for public consumption and for public debate. It's not trying to sell private advice to specific individuals, at least in the form of this project. Now, the main competitor, I think, that emerged in our discussions, and we compared the Doing Business project to when we were on our panel, was the work that the World Economic Forum does. Although actually, what's interesting is when you look at how the World Economic Forum produce their measures, which is not exclusively based on the Doing Business project, they do actually use quite a lot of the Doing Business indicators as part of what they do. So actually, there's a kind of a natural correlation between their indicators, but they also have their own sources of data. So the World Bank does not have a monopoly in relation to this exercise. The World Economic Forum is equally available and could be used. But I think it's fair to say it gets a lot less attention when it's published than Doing Business, and we'll come to that later. So the big question really is, does assembling these internationally comparable measures of the business climate, is it a useful guide to understanding growth and policy reform? If the answer is yes, then in a way the whole edifice is justified. And as we know, it fits very well, and it's not surprising, the timing of the project, of the Doing Business project, when it was formed, and the intellectual climate that underpinned it, was very much at a time when economists were coming back to the view that development and growth really depends heavily on having a suitable legal and regulatory environment that allows capital markets to work efficiently, product markets to work well, labor markets, that there was allied to this view that if we think that the problem of underdevelopment is both technological, not adopting best practice technology, but also resource misallocation, which is actually a much older tradition, going back to Arthur Lewis, the whole idea that what made underdeveloped economies different from developed economies was principally a problem that resources are misallocated on a grand scale. It's not just that the stocks of capital are lower. Of course, human and physical capital are lacking in developing countries, but those stocks of capital were being badly misallocated to ends that meant they weren't at their most productive use. The idea is that you can unleash those forces with regulatory and legal reform to allow resources to flow to their most efficient uses. And that idea, in a sense, development economics re-engaged with big time and has re-engaged with, and I'd say now it's the dominant paradigm within development economics to believe that getting a suitable underlying structure is what to support markets is the key to understanding why income levels differ so dramatically across countries, and therefore the key to unlocking economic progress. It's not the only thing that matters, but it's certainly one of the key things. And certainly I think there's been a change in mood and thinking, and I think the Doing Business project in a way was both reflective of that and perhaps contributed also to that perspective. So some factors are not, I mean, other things that I think are part of this, and I think Kaushik alluded to this in his comments too, is there's parts of this that prudent macroeconomic management has always been there lurking in the background, and we haven't changed our mind on that. But I think where people have been looking more carefully is what I like the term Kaushik used, the nuts and bolts. And I think there was much less focus on those nuts and bolts compared to these other factors in the past. The question is, if you're trying to assess a particular country's policy stance, policy capacities, if you look back 20 years and you said, how could I do that on this nuts and bolts side? What kind of data could I look at? What would be available? I think it's fair to say that there was relatively little internationally comparable data. There was one data set which sort of more or less ends its usefulness in 1997, which is the International Country Risk Guide, which of course was widely used by a large number of economists, and I'll talk a little bit about it in a minute. But how those data were constructed was is highly untransparent. Namely, it's very hard to get behind those data in the way that you can get behind the Doing Business indicators. And I think we forget that there was a world that preceded the Doing Business indicators where we have very, very little in the way of data to look specifically at these factors. So while one may be wary about the way some of these factors, some of these things are collected, and some of the conclusions that are drawn from them, one has to remember what world we came from. And I think therefore I think it has contributed to this, to the development of a paradigm that puts a lot of weight on these factors. Of course, what kind of underpins this? Why do we think some countries have better business climates than others? And there's another theme here which again is an emerging theme. To date it to any one specific paper or contribution, I think would be probably unduly precise. But again, an emerging theme has been that standing behind an effective business climate are effective states that operate in an intelligent way. And those factors, the factors of what creates an effective state, of course, have become a huge debating point too in the context of debates about development. And these days, certainly political and legal institutions are given a central place in what we think makes a state effective. Of course, that only pushes the question back one step further. Why is it that some countries have managed to acquire effective legal and political institutions? And I'm not going to touch that very big topic today. But the point is that why we think some countries are doing better or worse, we have to have an explanation for, and that probably comes down to some explanation based on the nature of the political and legal institutions that are at work in any particular context. So this does have an issue, it does have an implication for the way we think about the data and how we use them, though, because there's one possibility that many of the indicators we might put when we're putting the doing business indicators on the right-hand side of our regressions are really just proxies for having, in a more general sense, an effective state, and possibly attributing, therefore, the causality coming from the doing business indicators, rather than just because those are correlated with state effectiveness, becomes something of an issue. And I'll kind of return to that a little bit later as a sort of general point. So we all know, though, that, of course, there's a sort of unwritten theorem of economics is if you publish data, somebody will run some regressions on it. And in fact, if you look at the doing business project, it pretty much was part and parcel of the beginning of that project. There were a number of influential academic papers published almost at the very beginning of the whole project with some of the earliest indicators produced by that project. And that was in part because of the academic influence involved in setting up the project. Most of those, I think, who are running those regressions or have ever run regressions with the doing business indicators will be aware of the most obvious points that you're taught in grad school when running any kind of regression from day one, is that you have to worry about whether the things you're putting on the right-hand side are exogenous, whether they're just correlated with some emitter variables and all the usual stuff. I think less focus, though, has come on the heterogeneity point, which I'll talk about a little bit in a minute. Everyone, of course, understands that the heterogeneity point being, key point being, are you capturing by an average effect of something the kind of effects that you would expect in theory to look for? Now, that may sound like a slightly hard to swallow sentence, but in a minute I'll be clear exactly what I mean by that. Of course, these are well understood problems, but I think there was a certain amount of criticism that we detected as a panel when we were looking at this project, that not everybody has been entirely cautious in the way they interpret their results. That a lot of claims are frequently made on the back of running regressions using doing business indicators that seem to conveniently set aside some of what would be thought of as standard concerns. Of course, in a democratic world with free information, people can set aside whatever they like when they're making decisions. So you could just say, you put information out there, people read that information, they make of it what they will. If they're concerned about this, they'll draw the correct inferences. But even so, there is a question of whether somehow the right amount of caveat or the right caveats are always applied to some of the studies. But again, I'll come back to that in a minute. There's another issue that I want to come to, and that's the question of whether we think of these as inherently better looked at in macro or micro data. Of course, the measures, and Kaushik referred to this, are all collected based on a very specific sampling frame, which is essentially for a single city in each country. And therefore, relating that to macro data, economic performance as a whole could sometimes be deemed as somewhat heroic, meaning that you have to be sure that whatever that's going on in that particular location is in some way representative of the economy as a whole. And again, that's a criticism that one hears quite a bit about the way those data are used or can be used in some of the policy debate because of the specificity of the sample frame and the targeting towards particular kinds of incorporated businesses. Now, of course, we do have alternatives to that, and I'll talk about this again in a few minutes, and that's looking at the enterprise surveys, which of course the bank also has played a key role in producing, which are microdata that also try and get at the business climate. Now, of course, there's lots of reasons why microdata are never going to be able to collect data in either a timely fashion or even for such a wide range of countries. But the question of whether or not you're better off trying to gauge the business climate in microdata, looking at specific types of firms and trying to get at this at the firm level, or trying to do it at the macro level, hoping that you're capturing something that's relevant to the average behavior of an economy, is certainly quite a big issue that you have to confront when you're thinking about this. But I think the thing about the Doing Business project that probably makes it stand out more than any other project of a comparable kind is precisely the fact that the data are timely, that we get regular updates, and they're collected for a large number of countries on a comparable basis. I think that sets it quite apart as a tool for looking at this. But you have to think that's a particular window on the world, and the question is, what does that particular window offer in terms of ability to draw conclusions about policy? But I do think it's worth remarking that that does put this project in a very particular space. Okay. Now, I don't want to dwell on this because I want to cover as much ground as I can. But to some extent, you know, the kinds of indicators. So I was on this group called the Indicators Advisory Group. The idea, and I think still, modulo what Kaushik says about the way the thinking on this project is evolving, is still to try and create a deeper and more wide-ranging picture of the business climate. And it'd be very easy to think if you were sort of sitting, well, in Britain we always say sort of sitting in the pub over a pint, but whatever is the natural form of social interaction that individuals crave to have a debate about this, you'd quickly come up with the kinds of indicators that are on this list and say, look, if I'm trying to say, does country A have a climate that I think is going to encourage people to locate their businesses there, to grow their businesses there, I would have security of property rights, effective contracting, smart regulation, meaning that it's regulating in the way that does deliver on social, on an appropriate social mission, but with low costs of compliance, low levels of corruption, good infrastructure. It's not hard to, as that's why I call it the motherhood and apple pie, it's sort of not hard to think of all the good things that we would all like to see and that we think would be conducive to promoting a climate which is good for business investment. Of course, the question of what would be the quantitative gains from focusing on any of these priorities is far different from just saying we've got a nice laundry list here and we think it's all great and we'd like to measure it. It's precisely because we want to know what's quantitatively important, and that really does set aside, I think, the economic approach from many others, that we do, at the end of the day, put a lot of weight on the ability to quantify gains. It's not just about saying something is good or bad, it's how much would a change of size X imply for an outcome Y. And I was very struck, I'll refer again to this in a minute, but I did have a brief stint as a policy maker, 3 years as a member of the Monetary Policy Committee of the Bank of England, and it really drove home to me that there was no interesting question that we ever had that didn't have a quantitative basis. In other words, if we were going to cut interest rates, the question was it time to cut? How much should you cut? And then how much return should you expect from cutting by X%? It was an inherently quantitative exercise. And I think most of what we do in economics to be helpful and to set it apart from many other debates has to come down to an attempt to be quantitative. And so while we might have our sort of motherhood and apple pie, we want to ask much more than just saying, are these things we think are good? We want to say, how much are they things that we think have returns of size X or Y? And what should be the priorities in a country at a particular point in time? And that's a much harder question to answer. Okay, but I'll reflect a bit more on that in a moment. So let me actually talk about, since we have Hernando de Soto and as one of the speakers here, about something which I now refer to as the de Soto effect. So he's finally has an effect named after. I don't know if he knew that, but anyway. The idea that improving property rights yields high returns because it allows people to collateralize assets, an idea I found intriguing for a long time and would belong to, I think, the sort of motherhood and apple pie idea. But again, coming to the question of quantification, the question is, if I therefore perform a reform along those lines, what should I expect to happen? And how does that depend upon the particular environment in which I introduce that reform? Because that's the key question. If you're saying to a policymaker, look, you're ranking nth on some set of indicators according to doing business, and you can move yourself up the ranking with some reform, you really have to say, in this particular economy, given its particular conditions, how much do you expect for that to be the thing that is going to yield the highest return? One thing, so I'm referring here to a paper that published in the QJE in 2012 with Mojciech Gatak and Konrad Bechadi, where we looked at the quantitative significance of the De Soto effect, but in different environments. And the particular two things we looked at in particular were the distribution of wealth. So depending on whether you've got a lot of poor borrowers are going to benefit from this versus higher wealth borrowers, so the wealth distribution. And we also looked at the degree of competitiveness in the credit markets into which property rights reforms are introduced. So do people have viable outside options which they allow them to compete with other lenders or not? And the point we made in that paper is that the quantitative significance of this effect depends critically on the nature of the people to whom you're extending property rights, where in the wealth distribution they are, and also the degree of competition in credit markets. So here's a couple of pictures from that paper. So along the horizontal axis is our measure of the extent to which there's collateralizability of wealth, from no collateralizability through to full collateralizability. And these are calibrations based on a variety of different data, often data that's been estimated using randomized controlled trials, for example, to give us measures of the marginal product of capital and other things. You'll have to, unfortunately, read if you want to read the paper, you'll to get the detail. And essentially what we've done here is we do this for different wealth groups. This particular calibration is for Sri Lanka, where we got good data, but we did another calibration for Ghana. But you, in principle, could calibrate this to the circumstances of any economy. And the red group are what we call the low wealth group. This is what happens to the interest rate as you change the collateralizability of capital. The middle one is what happens to what we call the leverage ratio, the fraction of your wealth that you can borrow. And finally, what happens to the profits that borrowers earn from borrowing. And all I'm going to show you, I don't have time to go into the detail here. What you can see from here is there's a lot of heterogeneity on the quantitative size of these effects for different wealth groups. But more importantly, this is for the non-competitive case, okay? Now, if you compare it with, in the next slide, we do the same thing for the competitive case, we get very big differences. Now, depending on whether you're introducing, let me just go between the two, in particular, look at the interest rates. In a non-competitive environment, we're talking about interest rates of well over 100%, which we do see in the data, particularly in environments with poor borrowers. Whereas in the competitive case, interest rates themselves, the levels of interest rates are much lower. But also the size of these effects are all very contingent on the extent of competition. So why have I kind of mentioned this? What's this got to do with the bigger picture? I think it's got a lot to do with thinking about, if I'm going to use some particular set of measures from my motherhood and apple pie list, and I'm going to try and encourage government X or Y to follow best practice and move some of these measures, what should I actually expect to happen? And working that through in an economy, the heterogeneity question, I think, is absolutely key. Are you going to be in a kind of economy that's got the initial conditions that enable it to take a lot of advantage, which might be indicators of competition and wealth distribution in the case of this example? But it really matters what we would expect to see in terms of what we promise. Now, of course, there's a very old debate which this actually, it occurred to me, fits into, and it's a debate that the bank was very, very centrally involved in the early 1970s. So it sort of goes to the notion that there's nothing new under the sun at some level. And that was a debate about the use of cost-benefit analysis, where the idea was, if I undertake an analysis of a project, and to some extent doing policy reform of doing business indicators, in principle, would be nothing other than doing a kind of cost-benefit analysis of what private sector returns I would expect to generate from reforming the business climate. Conceptually, it's really no different. Of course, the apparatus is somewhat different in how you would do that. And to some extent, you can say what we were doing in that QJE paper was a kind of cost-benefit analysis for extending property rights for the use of collateral. Now, what was the debate? The debate was whether or not you assume that you're in an essentially first best or second best economy. And there was a debate between, on the one hand, Dasgupta, Marglin, and Sen, I think, on one hand, and Little and Merles on the other hand. Little and Merles said, no, you do cost-benefit analysis as if the rest of the economy is already operating in a first-best world, and you evaluate the returns based on that assumption, and then you do the projects that make sense at undistorted border prices. The Dasgupta, Marglin, Sen approach said, no, your economy is going to be distorted in a myriad of ways. You really ought to be thinking about the returns you're getting because of those distortions, maybe themselves being lower or higher. And it makes a big difference. Now, in a way, I'm more sympathetic, in spite of actually showing you something more in the spirit of what you might say Dasgupta, Sen, and Marglin were arguing here. I'm actually somewhat sympathetic to the idea that we should do it the Little and Merles way, and that's not only because Jim Merles was one of my thesis advisors at some point. It runs deep now. Amartya Sen was another one, so I was caught right in the middle anyway. But it's not just because of that, because I think actually doing a very contingent kind of doing business analysis begins to sound very weak-kneed, unless you've got very strong reasons for saying, look, in this economy, these kinds of reforms make no sense because there's a very uncompetitive credit market, let's say, for sake of example, and you're not going to get any returns. So if you don't make these reforms, you're kind of giving in to the fact that this credit market distortion is somehow fundamental. But on the other hand, it's going to make a huge difference to what policymakers actually see. They may get very disappointed. They may say, look, you encouraged us on the basis of this being first best reasoning to do X or Y, but we got very low returns. Why are you advocating this? So there is always the risk of the disappointment effect on policy when policy reforms that are apparently obviously good ideas don't actually yield good returns. Now, of course, that depends on having policy evaluation of a kind that is adequate enough to find those returns. But in some areas, we're beginning to see that kind of disappointment. And one example of that, actually, even on the De Soto effect, the regression-based evidence is all over the place. You get sometimes very low returns, sometimes quite high returns to reforming property rights on credit markets. But an area where it's particularly noticeable is the area of microfinance, where you get incredibly different returns in different contexts where people have evaluated microfinance projects. And there's a question, if you're going to encourage policymakers to pursue microfinance as an important tool of development, you've got to explain to them why it is that in many contexts we seem to see empirically quite low returns. And indeed, basically not significantly different from zero returns in a lot of evaluation studies. So that leads me to a small digression, for which you'll have to forgive me. But it sort of does reflect a little bit my own experiences. As I mentioned, I was a policymaker. And I think it really comes to the nub of three different ways or three different spheres of economics. And actually it goes a little bit with what Kaushik said in his remarks earlier, namely that academia is sort of wonderfully pristine, and I've retreated back into the world of academia since I left my position at the Bank of England and feel in many ways much more comfortable for it, where you can choose the time frame and you can choose the question. So in a way, it's even better. It's like a sort of doctor in a surgery. Someone comes in and they say, I've got this wrong with me. So actually, I don't want you to have that wrong with you. I'd like you to have something else wrong with you because that's what I think I can say something about. And academics are a bit like that. You can really pick the question as well as trying to pursue the answer. And you can pick the questions to which you think you might be able to find a plausible answer. But of course, at the end of the day, that's not always tremendously helpful. Of course, we will always make sounds that we're producing the fundamental long-run knowledge, which is valuable everywhere. And of course, that's right. I say it in a self-justificatory way. But I think there is something in that there's an important role for academics to pursue ideas independently of the pressure of what it is that policymakers or others think they should be working on at a point in time. Then there's a kind of intermediate point, which is policy advice and advocacy, where you have to decide, you've seen some research and you've kind of digested whatever you think the lessons are, which may or may not be directly relevant to the issues that the policymakers face. And that's where the kind of dilemma I talked about earlier comes in. Are you going to say, well, look, I've seen a return that showed that in country A, reforming this aspect of doing business had very big returns. Am I then going to go to a policymaker and say, you can have these returns too? Look at what happened in this country. The returns are really high. Then you want a piece of that. Just make those reforms, knowing that actually there were a very specific set of factors that might have gone alongside those reforms that you know may not be replicated in the environment in which you're actually giving the policy advice. And that creates a dilemma as to how you want to actually portray that advice. And the sort of portability of empirical knowledge here is hugely important. That's something that came home to me. I was a policymaker during the emergence of the global financial crisis. So I joined in 2006, I left in 2009. And one thing became clear very quickly during the period when the crisis really started to hit, which was post-Lehman's, was just how the kind of standard empirical relationships that you might have relied on in the more stable times were breaking down. So people who were giving you policy advice based on regression evidence during a stable economy were clearly not giving you policy advice that was much use in the context of the kind of economy that we transitioned to in the late 2008, early 2009 period. And then there's finally policy making itself, and the guys who do policy making, I mean, for one question is, do they even want to listen to the guys who do the policy advice? I mean, or are they convinced that they only, I mean, this would be particularly true of elected politicians. You know, I was elected to do this. You know, I told the citizens, if you put me in, I was going to do X or Y. I was going to reform the business climate. So it's not even of interest to them whether or not there's policy advice which indicates they've chosen the right thing. They've got the electoral mandate, and the electoral mandate to some extent trumps whatever it is that's being advocated by the policy economists. And very often they'll just pick the policy economists to give them the answer that supported the policy. So it's policy-based evidence rather than evidence-based policy. But that's natural. Democratic process encourages that. We encourage politicians. We hope that they're not so crazy that they ignore the evidence. But conditional on being elected to do something, they have a mandate to do it. And we have to respect that. It's part of the sovereign political process. So there's sort of very different modes in which economics can be influential or can't. So forgive me for that. This is just a little digression. Okay. Key features of good measures, I think, you know, we know what they are, and I'm going to not talk at length. They've got to be timely, relevant, comprehensive, comparable, and representative. And I think it's fair to say that when we got a lot of evidence given to us on the Doing Business project, which complained about some of this, but not all of it. No one complained particularly about the timeliness. After all, it was one of the few projects that could predictably produce annual data. Relevance, fair bit of criticism on relevance. Comprehensiveness, quite a lot of criticism on comprehensiveness. People said, well, where's infrastructure in here? I mean, infrastructure is surely a central feature of the business climate, and it's not really part of doing business. And then particular features of measures that Kaushik talked about, taxation and labor regulation being particularly two controversial measures. Comparability. Now, comparability is going to bring some element of sacrifice, inevitably, because you cannot be comparable without having to choose a particular frame that's not going to be entirely suitable. And actually, there's been a sort of change in national income accounting, which is sort of interesting in this context. When national income accounts were created in the mid part of the last century, they very much suited the economies, which predominantly manufacturing and agriculture, partly because you could count outputs and inputs really rather well. As we've transitioned to an economy, particularly in the developed world, that's much more service sector dependent, measuring outputs from service sector industries is much, much harder to do than measuring the number of trucks or tanks or whatever it was you wanted to look at coming off the production lines. So we know that, therefore, the comparability of methodologies for looking across countries in terms of national income accounts are actually quite problematic. Yet we use these data, often sweeping those issues under the carpet. But comparability is not a straightforward thing to achieve when you have very different kinds of economic structures. Now, what Doing Business does is to focus on a particular type of business. That type of business is more or less representative of business as a whole, depending on the country you choose to look at. But this is an inevitable compromise, and it needs to be borne into in the mind once one looks at how the data are going to be used. And of course, that comes to representativeness. Now, an interesting question is, does it matter who produces the data? And our committee had quite a lot of discussion around this issue. I mean, one of the issues is, in what sense are the doing business indicators an official product endorsed by the board of the World Bank as, in some ways, certifiably high-quality, relevant data? Now, you may say this isn't very important. After all, you just put them out there and people can use them or ignore them. That's up to the users. In fact, in most countries that have sophisticated statistical services, a huge amount of effort goes in to deciding what is official data and whether that official data passes certain tests. And often statistical agencies also have a degree of independence. They are allowed to choose, because they don't want the politicians to conveniently engineer fictitious economic booms ahead of the election or anything like that. The statistical agencies are both independent and they use quality certification. Now, there's a sort of interesting question when, and often they're produced by an agency that has no other function than to produce data. You know, we don't bundle that with any other activity. Now, there is a sort of interesting question. The bank is not a data generator. I mean, it happens to produce a certain amount of data in its course of its business, quite rightly. But it's not, raison d'etre is not to go around the world collecting data. It's a bank. You know, it does more besides. It's also, as we know, a knowledge bank, a bank that's meant to discuss and debate best practice and policy in other areas. But fundamentally, at the end of the day, it lends money. And the question is, does that sort of bundling of information provision of a particular kind with lending in any way compromise the integrity of making doing business an official project? So an example would be whether or not the doing business indicators could become part of the conditionality of lending. That's a question the bank has to think about. Would it ever say that we will lend you money for this, this, or this? As a quid pro quo, you have got to, or we're hoping you will look at reforms along the following dimensions. Then it becomes much more than independent judgment and collection of information. Although you can kind of try and create that Chinese wall that says the guys producing the data are quite separate. But from the outside world's perspective, they may be concerned that you're kind of being both judge and jury at some level. And that's an issue clearly when in the representation that we as a group received is a perception that people had, that the bank was both trying to promote a particular model of development through those indicators, and therefore the question of whether these were operationally relevant or not was kind of blurred, and people didn't fully understand where the bank stood on that question. So there's a kind of range of gray, there's an interesting gray area there. For most official data, there's a system of scrutiny and quality control which is transparent. We have in the UK an independent statistics commissioner whose job it is to keep politicians in particular at arm's length when it comes to creating national data, and has ultimately the ability to, and there's a scrutiny board on methodology and other things for collecting official data and deciding to some extent what data is collected. That's a gray area, by the way. We now are producing data in the UK on national well-being based on sort of happiness and other indicators. The question of whether the politicians get to decide what you collect data on, or whether, you know, conditional on collecting it, how it's done. I mean, there's a lot of, even there's gray area. I'm going to skip through this very fast. I mean, I think we all understand the rationale for providing information on an international basis, on a comparable basis. And I think, I don't know whether Andre is already here, but Andre Schleifer had coined this wonderful term in one of his early papers, yardstick competition. And I'm sure that's what he'll talk about in tomorrow's panel, so I don't want to sort of steal the thunder of that. But the idea is, you know, you give a basis for governments to compete and to compare themselves. And certainly to the extent that these measures are used in Europe, and depends I've seen them, which is sort of filtered, say, via the Financial Times or whatever, it's most often in the context of showing a league table and saying, you know, Portugal is doing better than Spain, is doing worse than Italy or whatever. These things are used, and then politicians respond to that. Why is it and there's a kind of implicit kind of yardstick competition generated around data that allow countries to think about where they stand in relation to others. And you can therefore think, if you believe these data are relevant and they're comparable, then they create the basis for a kind of incentive scheme among politicians. That's one case for doing it. Of course, one of the obvious criticisms of any of this is you get the equivalent of teaching to the test, in which people realize that they can, to some extent, game these indicators by deciding to pass, quotes, cosmetic reforms of very little substance that mean that they can push themselves up the ranking. Now, I know I wouldn't dare to say whether this has ever gone on in the context of doing business, because I simply don't know. But certainly there are people who I've heard make claims along that. Then there are sort of issues around information processing, which I have relatively little sympathy. On the basis that, I think it's dangerous at some level to start taking these arguments too seriously unless you're very convinced. The burden of proof has to be very strong. But one is a kind of behavioral biases point, that you're actually leading people through the way you collect data to think about the world in a particular way. Now, I do think that to some extent is true. I mean, if we had no data on human rights violations collected by an international organization like Amnesty, I'm sure we would not be thinking as hard as we do about why some countries are performing better or worse on that. Those data do kind of lead us to think in what's salient and what isn't about cross-country comparison. So I think we kid ourselves if we don't think that we're drawing attention through the collection of data of particular things. On the other hand, on the basis you can always discard data, I feel a little uncomfortable saying this is an argument for not producing the data, because we think that people are inclined to obsess on certain salient dimensions that we think they shouldn't obsess on. And of course, there's politics too. We in some countries, the political class is trusted a lot better than in other countries. And we want the political class to take seriously what's valuable in an internationally comparable environment and discard what isn't, and to make that intelligent judgment. But if you believe there are all sorts of behavioral and all sorts of political biases, you might be concerned that actually the political class will misuse these data. Again, I mean, I can see the validity of that argument, but I would say that's a weak argument to actually silence those who are producing data. And then the sort of framing, how do you present the information? And I think there was a big debate, and there probably still is a big debate since it's unresolved, about the aggregation issues. Producing a country ranking out of the doing business indicators was a way of creating a huge amount of salience for the doing business report. I have no doubt about that. That people looked at rankings and they looked who was above whom, and they decided on the basis of that to draw certain conclusions. So ranking created a certain kind of political certain kind of political salience. So the question of how you choose to present these data are critical. And we know kind of already from a wide range of psychological studies that framing is hugely important to the way people respond. So we shouldn't pretend, just bury our heads and say, oh, it's all irrelevant. Framing effects in studies in the lab tell us that the way you feed people information can have a very big impact on the way that information is used. So I just put that out there as a thought. Implementation, I just want to say a word on that, because one other set of issues is how far do you want your indicators to be what you might call de jure or de facto is a big issue. Do you think you want to kind of measure laws on the books, or do you think you have some way of talking about the way those laws are actually implemented? And the kinds of indicators you might collect if you're trying to collect de jure versus de facto is important. And again, concerns that came to us as a panel were often, well, you can reform a law that just requires an act of parliament, but to fundamentally change the way the business climate works requires you to have effective implementation of that law and effective change. And are you actually measuring the effective change, or are you just measuring the de jure change? And of course, to some extent, lurking behind all this is the sort of state's institutional capacity. And in fact, when Kaushik referred to the work I did with Robin Burgess, where we looked at labor regulations in different states in India, and one quite valid, we did it entirely de jure, I should say. We simply read the laws in terms of the Industrial Disputes Act and used that to assign different labor regulations environments to different states in India to see what had happened. And a perfectly valid critique of that is, well, do we know that those are the actual laws that firms respond to? And the answer is we didn't. We simply, I hope, honestly presented the evidence that we had. We said, look, now that's what we're doing. We're looking at the de jure. The question of what the direction of bias would have been to look at de facto, I have no idea, because we didn't have any de facto measures. But it's a certainly a valid critique of what we did to say we focused on the de jure rather than the de facto. But whether that meant our results were biased in a particular direction, that's not entirely clear. Kaushik talked about this. The question of whether you need to go to subnational or not is a major issue, and certainly something which was widely discussed in the in our deliberations, and I think is a wholly worthwhile thing to move in that direction. But obviously a major undertaking. It's not something one would do on the stroke of a pen. A lot has to be thought through. And of course, it's still true that in many countries, the national government has as the levers of its policy, under its policy control, the major things that really matter. So there's only so far you can go. And Kaushik pointed out, in India, states have certain things on the concurrent list, but other things in India are controlled pretty much from the center. So you would have to be sensitive to the particular policy environment in different countries, the extent to which there's genuine decentralization of decision-making or not. So it's not a trivial exercise, but I can certainly see the value of that. Okay, now, of course, I've been really talking about doing business all the way along, implicitly or explicitly, mostly explicitly, in fact, a bit more explicitly than I thought I might when I was looking at the slides and putting the slides together. But anyway, let me talk at one or two things about doing business more particularly, which bear on some of the issues I've already talked about. We all know we're sort of here today because the Doing Business project was a huge success for the bank as a product. Namely, it's a hugely salient product. It's a product that gets debated. I don't imagine that those who started the project 10 or 11 and a half years ago did envisage that the project would have as much resonance as it indeed has had and been as successful as it's been. I mean, I guess they were the two guys I know who were involved early on are quite upbeat guys, so probably they would have said, yeah, we're gonna change the world with this project. But I still think perhaps it's been certainly than I might have expected when at the outset. It's been a hugely successful project in terms of being something that is debated. And in a way, the process that was initiated actually is in 2012, and that I was involved in, was to some extent a product of that fact. The fact that the project had become highly salient, highly debated, and therefore there were certain questions being asked about the project precisely because of that. Now, what we know is it has a particular methodology. I'm not going to rehearse that because you're all familiar with it. I think I'll echo something that Kaushik said, which I think is important. Compared to almost all other exercises of this kind, the Doing Business project is incredibly transparent and clear about what it's doing. Now, that doesn't mean that everybody who quotes it is transparent and clear about what it's doing. But the project itself, it is not particularly difficult to go on the web and to figure out exactly what the blend of sausages is. I mean, and unlike most brands of sausages, I think it's much clearer. So it is clear about its methodology. That's not to say this methodology does not have a variety of debates around it, and I talked about some of those already, but it is, I think, to be fair, clearly documented. I think it's rightly or wrongly often viewed as an official output of the World Bank. And this did become, or is an issue for the bank. Because the question of what does it mean to be an official output? Does it mean that the World Bank in some fashion is adopting a particular view of what policy development ought to look like in different countries? And I think it's a very difficult issue for the bank. I think the bank does have, through some process of internal and maybe external debate, a view about the kinds of policy environments that are conducive to development. But the bank, for example, does not, as far as I know, take a view on whether democracy is something that is a valuable asset to economic development. Unlike, for example, the EBRD. The EBRD actually has it built into its mandate, into its core articles, that it can only lend to democracies. And there have been, and there will be. I mean, look at Ukraine today. I don't know if the Ukraine is still borrowing money from EBRD, but there are going to be serious debates about whether particular countries that are in the EBRD stable, for want of a better term, are going to continue to receive money if there are changes in their political system. So there are things that the bank has steered for, I think, perfectly understandable reasons away from, and it was not part of the initial charter of the bank. But I think the question of what can be and what it would mean to be an official publication, I think, is something that the bank has to, and Kaushik, in his new role as having this within his portfolio, have to take a view on. And it doesn't surprise me, therefore, that the bank board, which I think is the ultimate oversight agent of the bank, does want to debate this product. What are some of the issues? Well, I'm going to skate over this issue because I think you kind of all know this, but there's sort of, as I said, there's two sets of things we kind of do with the doing business indicators, which are part of the justification of the exercise. At least the top one is. The second one, we can see whether we think it is or not, but the top one certainly is, and that's the view that we believe these indicators are in some meaningful way representative of things that lead to good economic performance. And the way that's typically looked at, and I imagine in many of the papers that are presented at this conference will be in the spirit of that, is to find some interesting way to find an outcome variable that we care about and to show that it's correlated in some particular way with some doing business measures. And people, put a lot of time into, thinking carefully about that, and they do the usual thing of submitting to journals where referees spend even more time trying to persuade them they haven't spent enough time already, worrying about these things and so forth and so on, until eventually a product is produced that can at least be deemed to be worthy of a peer-reviewed outcome. And the number of peer-reviewed papers that use the doing business indicators, I can't remember the exact numbers. Augusto may remember them off the top of his head there, but there was some vast number that have used these and run a variety of different regressions based on these indicators. These indicators have also been put on the left-hand side, and that comes to this slightly trickier question. Are we really thinking of doing business indicators as a reflection of a particular kind of institutional structure? For example, is it true that democracies systematically score more highly on these indicators? In other words, is there a case reflected through the doing business indicators for particular institutional structures? That is clearly not part of the agenda of the people who produce the data, but it's very much part of the debate that's gone on around these indicators. And there are many papers, indeed I've been responsible for them, that put the doing business indicators on the left-hand side of regressions rather than on the right-hand side, and ask the question, which countries seem to do better? What are the characteristics of countries that do better? Okay. In terms of doing business on the right-hand side, I've got some tables. They're probably not even legible, so I'll probably just summarize them in words. One thing we did, me and my RA did, as part of the preparatory work for my work on the commission, was to sort of go through, there was an earlier report, I think Simon Commander and someone else produced it, on kind of trying to step back and say, there are all these different regression evidence, what does it kind of add up to here? The fact is, I think it's fair to say that two things come out that I'm convinced about, is that if you look at sort of average effects, of doing business indicators, depending on what you put on the left-hand side. There's guys, Kaushik quite rightly critiqued the indicators if you use them as trying to predict output per capita or growth. Because to some extent, if you want to care about growth, you look at growth. On the other hand, claims are often made about the correlation between these indicators and growth that need to be investigated, because people will say the reason you want to reform your business climate is because there are returns in that form. So one can look at those, but the patterns are mixed. I think you could basically take what you might call a half-full or half-empty view on this, namely that some patterns come out and seem to be very robust in the data and seem to go in the direction that people who believe these are valid indicators of improvements, and they hold up in quite demanding specifications, including country fixed effects and looking at long-term patterns of growth and so forth. I've got tables here to show you what I mean, but I'm going to skate over them because I'm really running out of time here. Equally, you can go to the World Bank Enterprise surveys, and what we did was to download all the enterprise surveys and go through and look and see, for different categories of firms, were there robust correlations between firms reported indicators, because there's often an opportunity to triangulate here, because often they will ask similar questions to firms that the doing business indicators are asking through its network. And we tried to correlate those and to see how much correlation there was, and whether that correlation was heterogeneous by firm type. For example, whether the firm is located in the capital city, whether it's a large or small firm. And again, we investigated that, and I've got tables on that, but I don't have time to show you those. But the bottom line is, so just to prove I was not lying, there's the tables. There we are, you see, passing before your eyes. I told you they weren't very good anyway, so it'd take me ages to do it. But if anyone wants to download my presentation and study them, they can. I've actually got a longer document that documents all of that, tells you exactly what we did, and I'd be more than happy to email it to anybody who wants to see that, because we just produced that as a kind of background document for our review. So the question is sort of, what should we conclude from this large industry? And some studies, by the way, are really creative and interesting, and I think have taught us a lot on this front. So I'm not actually saying that in any way the literature is compromised. But the fact of the matter is, if you look in broad terms, there's quite a lot of sort of fairly mixed results. Now, of course, I actually don't think in the end this is either a way to attack or defend the doing business project. That's why in some ways I'm completely cool about this finding. At some level, I don't actually think the average effects, I think I already explained why I think that in my example on heterogeneity, are at all interesting for the most part. I think the real work, the interesting work, is looking for the theory-based heterogeneous effects for particular indicators where we think that for some reason particular subsets of firms would benefit, and try and get at those really much more detailed studies. I think that's where the work is to be done, much more than looking at sort of average effects in economies, because there are many reasons why average effects are not really going to serve well here. This is an example of what happens when this is from a paper I published with Torsten Persson in the American Economic Review in 2009, where we used the doing business indicators on the left-hand side, where we looked at ease of access to credit. And this is something a lot of other people have done. One thing you find is different measures of institutions, the extent of democracy, the incidence particularly of parliamentary democracy, legal origins and other things are correlated with these indicators on the left. Now, the reason I put this up is not to persuade you I know the answer to some sort of underlying particular relationship. We were doing this in the context of a particular exercise where we were trying to argue something. But the fact of the matter is that it raises the question of whether a lot of times when you do this exercise and you look at doing business on the left-hand side, you find very similar patterns across a whole range of indicators. And the reason that's important is because it suggests that there's some underlying core measures of state effectiveness that are actually driving a whole variety of indicators. And therefore, just focusing on one specific indicator may mean that we're just getting something that's a proxy for state effectiveness more generally. And I think that's a tale we should be cautious on. Okay, I talked about this, I think, already. The coverage and measurement. There are areas where I think there's justifiably debate about which areas should be in or out. The labor regulations indicator has been suspended, although, as Kaushik said, there's work hopefully going on that's going to talk about what to do next on that, in particular in the light of the WDR. Taxation is an interesting area where I would like to see, between the bank and the fund is doing work on taxation as well, a really good, much more open debate about what kinds of tax climates are effective or not. I actually think not just a question about rates. The rates issue is I think, secondary to the base issue. The question of how you have the right tax base is probably far more important than the question of what rates you charge, modulo rates not being punitive. Questions about aggregation, I'll leave to the politicians to some extent. On the other hand, it is worth saying that, and I don't know whether this is still unresolved business, as you know, our panel made sort of two comments on aggregation. One was that we thought that the rankings were creating too much political heat and therefore were not being helpful. Now, but we said at the same time, if you drop the rankings, people are going to take a lot less notice of this, and moreover, they can go produce them anyway. It just won't be the bank that's producing them. So on the one hand, we said we thought there was too much politics around the rankings, and therefore they should be suspended. But equally, there were two consequences of dropping them. They're highly salient, and as I say, anyone could sample them. But this issue is not going to go away. What I would like to see personally is more work on how one aggregates indicators in an interesting way to see what signal there is in here compared to noise, and say, look, we're not just going to drop the idea of aggregation completely, but we're going to think hard about how aggregation is done in a way that's more scientifically defensible. So that's personally where I would like to see that go. But I can see the politics around the rankings is a big issue. So I'm done. Bottom line, I think there is a strong case for maintaining a project in the World Bank, and I think I know we concluded this in our report, that looks seriously and systematically at the business climate and thinks of the best way to do that. And I stand behind that recommendation, and I think it's an important recommendation because it was not something that a lot of people thought was an obvious consequence of the review that we conducted. But I do believe that. The project, like everything in life, has to be suitably modest in what it achieves. It cannot claim to be creating anything more than useful, indicative knowledge, which, if used in the right way, can contribute importantly to debates that I think that we all care about. But equally, I think there is a kind of a, and I think it was clear by the time our committee was appointed, this had kind of reached a point. This has become and will remain a highly politically charged part of what the bank does. And it has to build structures, institutions, so coming back to my big theme, the bank has to build institutions that are most effective in delivering this product in a way that's going to give it the most credibility, so it's been scrutinized and people know that. Because I do actually think it's important that the bank resists the kind of lowest common denominator, namely if some particular country takes exception to the way its business climate is being portrayed, prima facie they may have a point, but it's not the case that the bank oughtn't in some cases to be resistant to that and say, no, actually we think we stand behind this because we actually have done this in a way we think is careful and measured and sensible, and we're going to stand behind that, what we found. It is important for the bank to be able to do that, but for the bank to be able to do that, it has to build the structure and put it in place that makes that process entirely credible and independent. So I think the bank has to recognize those political sensitivities, but I think the move towards, I mean, as if Kaushik hadn't got enough to do, but the move towards Kaushik's part of the bank, I think, will allow it to be reintegrated more with the more general development economics research at the bank, which I think is personally, since I signed up to the report and that was one of our recommendations, I personally think is helpful, and maybe we'll be back here in 11 and a half years on the 23rd anniversary of the Doing Business report and discussing its further achievements, hopefully in a world where countries that are not doing the best to promote business, and there are many, and we mustn't forget that, have improved their business climates, and to some extent that the report that we're debating here has played a key role in providing the right kind of debate and analysis that underpins that. Thank you.
Tim, thank you very much for a very provocative and stimulating talk. I can't imagine a better way to kick us off. We now are very fortunate to have Stephen O'Connell, the Chief Economist for USAID, to offer some reflections on Tim's speech. Thank you.
Thank you very much, John, and it's a real pleasure to be here. I want to thank the World Bank for sponsoring this conference and Georgetown for hosting it. This is an area that has been of great interest and commitment for USAID really from the very beginning. So it's terrific to have a chance to respond to this very comprehensive, insightful talk by Tim, and to look forward to the papers over the next few days that will be taking up a lot of these themes. from the research side. So let me make just a few comments. Tim's treatment of the issues was comprehensive. I won't try to do that. I'll try to say a little bit about USAID's interest in the Doing Business project, how it affects our work, why we're invested in it, why we think this is a critical time, and are fully behind the recommendation of Tim's group and Kaushik's plans at the World Bank to push the project forward. So let me just underscore that we have been supporters of the project really from the outset. This is in the early 2000s, and have used the Doing Business indicators in a whole range of our activities. So for example, when we do a growth diagnostic for a country that we're partnering with, trying to understand, to identify those areas of policy reform that would have a high impact in terms of inclusive growth, meaning contributing to long-run growth, but with a very heavy emphasis on the word inclusive, long-run growth that would create employment and that would particularly increase the welfare of poor households. So we do these not for every country that we're operating in, but for quite a number of them. And the Doing Business indicators are part of that exercise because of the virtues that Tim outlined. They're comparable across countries. So in an attempt to benchmark realistically relative to government capacity to level of development, we find them extremely useful. They are tied quite deeply to evidence year to year on what firms say they actually care about, from the World Bank's own enterprise surveys, for example. So, for example, Tim mentioned that there had been at the outset very thin coverage of infrastructure as a concern to small and medium-sized enterprises, and that infrastructure, access to electricity, for example, bubbled up in the World Bank's enterprise surveys very, very clearly, and has been incorporated within the Doing Business indicators. This is an exercise that's ongoing to try to make sure that the things being measured in the exercise are sort of ground truthed against the things that firms actually say constrain them. So for our exercises, again, the data are comparable, therefore potentially useful for benchmarking in a realistic way. They are collected at arm's length and therefore possibly subject to the gaming concerns. I'll get to that from a slightly different angle than Tim's maybe, but they are collected at arm's length and therefore we think of them as credible measures of the aspects of the environment they're trying to measure. So there's one domain in which we found this exercise extremely useful in our operations and our programming. I think the other one, which I'll try to come back to, is that ultimately we feel that we're often in the position of trying to partner with what you might call development entrepreneurs. And what I mean by that is agents within an economy who have identified areas in which they want to carry the economy forward, specific constraints they have diagnosed as being critical for achieving high-level objectives like employment, economic growth, reducing the poverty headcount. And we think of those development entrepreneurs, which can be the president all the way down through the civil service to people in civil society and academia and elsewhere. We think of them as confronting extremely serious and deep difficulties in the sense that the framework that they're trying to change is an equilibrium. In other words, it's a framework that has settled over long periods of time. It is a set of institutions in the way that Douglas North and others described institutions, as arrangements that are understood generally, as systems of incentives that people accommodate to and perpetuate, as things that only change pretty slowly over time. And so we think of development entrepreneurs as trying to move into that kind of a space, which is extremely difficult and hugely valuable, we think, for them, is measurable objectives that are credibly tied to higher level objectives, but that you can usefully think of trying to hold public officials to in an effort to try to get at higher level objectives. Okay, so I'll get back to this a little bit more, but our feeling is that these indicators have been extremely useful for high-level policymakers who are trying to shift the way things are done and move things in a positive direction and capture some big objectives, high-level objectives like inclusive growth. So let me just say a little bit about what we're currently doing to try to support the ongoing development of the doing business indicators and to try to conform our own practices to what we're learning and what the whole research community and practice community is learning about these indicators and the business environment. So currently we're partnering with the IFC and DFID and the Government of Canada in a 5-year effort to do something a little similar to Tim's tables, among other things. In other words, to aggregate the really overwhelming evidence in the literature. In other words, to write big literature reviews that really try to come to grips with what we've learned. Because it's quite staggering how much research has been stimulated by the transparency, comparability, and availability of these indicators. It's getting to near 1,500 peer-reviewed, in other words, refereed journal articles at this point that use the doing business indicators as typically a right-hand side variable, in other words, a determinant of other things, but as Tim said, also trying to understand what drives them over time. So one of the things we're doing is some literature review work, and I'll report on at least one aspect of that. And then also doing our own cost-benefit analysis and cost-effectiveness assessments of our own of policy reform efforts in the investment climate area that we have supported. So trying to look at those things and get a sense of what their effectiveness has been and what their staying power has been in terms of actually generating institutional changes. And then I'll just underscore that we're probably engaged actively in programming around the business climate in something like 20 of the countries reported, even in this year's Doing Business report, as having made major improvements on one or more of these indicators. So let me now move to a couple of points about maybe relevant for the researchers who are going to come over the next couple of days, because research has been, at the end of the day, we have our high-level objectives as partners with countries, as policymakers within countries, and then we have major questions about what the evidence base is that can help guide what we actually do, and that's where research is really so critical. So I'm going to just make 2 points. So one thing, I want to underscore what Tim called the teaching to the test problem, because I think it's a very fundamental problem, and I think of it as being a good bit deeper than the problem of gaming the indicators. In other words, you set up the indicators, policymakers, since these are de jure indicators, mostly. These are laws mostly, maybe 3/4 or 2/3 plus of these are laws. They're not the de facto indicators of actually whether those laws are being implemented. I'll get back to that. although there is some of that kind of information as well. But there is the concern that it costs nothing for a policymaker to change some laws and arrange that to be done. And if resources are leveraged on that and the perceptions of the business community are leveraged on that, that could be a formula for very, very low effectiveness if those rules are in fact just a veil. They're just something you can change and it don't get enforced and don't have leverage. I think of a deeper problem when I think in terms of development entrepreneurs. So let's suppose you do want to improve the business environment in your country. And your objective in doing that is to achieve some very higher level objectives, like inclusive growth. You're going to have to motivate your public officials, your entire government essentially, around this project of improving the business environment. And a lot of that motivation, changing the rules, may be fairly straightforward to do. But the deeper question for you is how to actually motivate and create incentives for performance. So the rules are only part of that. So behind each change in the rules, it seems to me, for countries that really are trying to move forward, the rules are a critical instrument because they also inform where to concentrate effort in terms of measurability of de facto performance. So change the rules and then measure de facto performance of your public officials and try to move them towards those rules. And it's in that second domain where it seems to me it's just a critical question, the one Tim posed. Are these benchmarks, in fact, dimensions on which we would like to have leverage on actual performance because they matter for outcomes? Or are they the correlates of much deeper things that drive a good business climate? Okay? If you just change them for free, you do no harm. But if you focus real effort on concentrating reforms, on making people accountable for these things, and they're not well linked to the outcomes you care about, then you really have a first-order distortion, all the way from the political level on down. So to me, the question of the quality of our evidence linking these indicators to the outcomes we care about is a really big question. And Tim mentioned what I think of as being kind of the most enterprising dimension of work on trying to get good evidence, which is where you kind of give up on being able to control for all of the difficult confounding factors and zero in on the difference between what happens to small firms, medium firms, and large firms, or other aspects within a country. Okay, and that, by looking within countries, rather than trying to use the cross-country comparability of the indicators, you're protecting yourself from factors that differ across countries that these regulations may be proxying for and that you cannot disentangle because you can't measure them. So zeroing in the way Tim suggests is very, very powerful. I just want to back off one step to a zeroing in that's a slightly higher level is essentially, I think, about average effect, what Tim called average effect sizes. And that's where you might be able to exploit a kind of natural experiment in how regulations are rolled out in order to try to tease out what impact those regulations actually had. So for example, within India, a federal system, states might respond to a national impetus to change the investment climate at different pace and in detail over a period of 4 or 5 years. You might see reforms going on within the full set of states, but happening at different times. Okay? So looking at the variation in state-level outcomes for new firm creation, let's say these are business entry regulations, or employment, or formalization of informal enterprises. Okay, so outcome variables that you care about, looking at the cross-state variation and how that lines up with the actual timing of the implementation of these policy reforms state by state, can protect you from a lot of the heterogeneity, the unobserved variables that might otherwise be explaining why you had more formalization of small-scale enterprises in this state versus that state. So it's been 10 years of research on these indicators. I think the quality of the research has gotten better and better and better. And as the indicators, one of the dimensions that the bank is pushing them now is towards including not just the single capital city in a country, but also pressing out the effort to some other locations within country. That's the kind of thing that will, I think, open up new avenues for researchers to kind of find variation in the data that will help us be confident about causal impacts. So that's one point I wanted to make. And in our overview ongoing of the literature, we find that the number of natural experiments-based papers is expanding. It's expanding slowly. There may be fewer than about 10 of them, really good ones out there, but we're getting there. And so the quality of the evidence, it seems to me, is advancing. And my sense of it, you'll probably contest this, you know this literature much better than I do. My sense of it so far is that as you go up the scale of credibility of this evidence, it has not tended to make things deeply more complicated. It's tended to confirm the earlier correlations that suggested that there's traction in some of these indicators for the outcomes we really care about. Let me touch one other issue that Tim mentioned that I think is super interesting, maybe super difficult, and therefore exactly what the academics in the audience are going to be telling us about over the next maybe couple of days and later. And that is, I think we also need better evidence on what you might call sort of institutional dynamics. In other words, let me read, just try to frame this by reading you a quote from one of the first classic papers by Jankoff, Laporta, Lopez de Solanas, and Schleifer. This is QJE, the Quarterly Journal of Economics, 2002. This, I think, it may be one of the founding papers of the whole project. It was a paper that did a data collection exercise on the cost of entry. How much does it cost for a new firm, a new enterprise, to be established within a country, generated cross-country data? Here's a quote from that paper, quote, "The evidence in this paper is inconsistent with public interest theories of regulation, but supports the public choice view that entry regulation benefits politicians and bureaucrats." So this is what I mean by framing the issue in practice in terms of policymakers and their partners as entering into an equilibrium, inconsistent with public interest theories. What that means is it's inconsistent with the view that the regulatory regime was created by Plato or some other philosopher king as the optimum response to the collective interest of the private sector and households in having a strong regulatory regime. A normative theory of government not paid much attention to by political science, but greatly loved by economists, I think. But the evidence, they say, is inconsistent with that view. What it's consistent with is a view that the array of regulations that you see and the degree of enforcement of those regulations is some kind of equilibrium that reflects the interests of the groups that promulgate the regulations and the groups that enforce them. That is, the politicians and the bureaucrats. So you are starting a reform effort with the problem of understanding that equilibrium and that array of interests, and that's why I use the term development entrepreneur, and thinking of ways in which to move it creatively and durably. And so here, I guess it seems to me there are maybe two things at least that I think we'd love to have a better grip on. One is a simple question of whether institutional changes in these measures are sustained over time, and what are the determinants of that. Okay, because if you're moving into what is really an equilibrium, and an equilibrium that is shifting in a path-dependent sort of way, the shortest, best answer, first answer anyway, to the teaching to the test problem is whether those regulations go away as soon as they've accomplished their objectives, whatever their objectives were. Getting the Millennium Challenge Corporation to give you $300 million for 5 years, or some other short-run objective. So evidence, retrospective assessments of reform programs that have targeted these indicators or closely allied ones. What do we know ex post about the staying power of those interventions? And we're involved right now at USAID in doing some retrospective assessment of our investment climate programs in places like Kenya and Sierra Leone and some others. The second one is, I think, a really critical distinction Tim underscored between the de facto regulatory regime, which is the rules on the books. Sorry, that's the de jure. Between the de jure regulatory regime, the rules on the books, and the de facto regime, which is how things actually work. And really the thrust of a lot of thinking in economics over the last 15 years and more in the economics of economic growth and long-run development has been to push attention towards the de facto regime as the thing that really matters. Now, the doing business indicators have a strong component of de jure regime. They're looking at the legal structure. They also have measures of cost and sort of throughput for the case study exercises that they try to run within each country. How much time would it actually take for you to get through this set of steps in order to establish your business? But it seems to me that work on the relation between these de jure measures and measures of de facto performance, which are harder, more contestable, harder to collect, more expensive, I'm sure, to collect, and more contestable. But understanding that relationship seems to me to be really, really a critical one. And particularly on the issue of the convergence, the process of convergence of the de facto performance to the de jure rules. Well, I think I'm going to wrap up. I don't know if we want to have time for, I have -3 minutes. I will wrap up. Let me wrap up by just saying again that it's, I think, a rewarding experience it will be for you to go back to Tim's presentation and to get a sense of the whole range of issues that he's raised for us. I think a lot of them are going to be addressed in the papers and the sessions over the next couple of days. Speaking from the USAID side, we are really delighted that the bank is in a kind of recommitment mode, we think very constructively and dynamically with this project. We're going to support that every way we can. Thanks very much.
Well, folks have been very patient this morning, and I think we are due a coffee break. But I do want to allow because there's been so much good, stimulating discussion from the dais here, to just allow for a question or two before we take a coffee break, and then I'll make an announcement about where we're going after the coffee break. But if you have a question, if you'll just simply come to the microphone on the aisleways, there's a microphone on my left and on my right, questions that might be addressed to either Tim or Steve. If you could, just come on down to the microphone so everyone could hear you, please. And I'll just ask the relevant party to come up and answer the question.
It's a Goldberg. I want to follow up on the gentleman from USAID point on de jure. It's not new, as you know. We have two parallel tracks. One is doing business, and the other one are enterprise surveys, called BEEPs, called whatever names, depending on the region. And they are parallel, those tracks, and that's unfortunate, because addressing your question of the de facto could be done partly by surveys, but somehow, for whatever reason, we haven't been able to reconcile them in the countries that I worked on. Thank you.
I don't know that there was a question. Was there a question? Maybe just an observation. All right. Is there time? We have time for maybe one more question or comment. Any? If you could just come down to the podium or to the microphone, please.
Thank you very much for your talks this morning. I want to begin by saying I'm engaged in a natural experiment of implementing a law in a country that is aiming to regulate the private health sector. So we have a de jure situation, and I'm in the process of taking the Ministry of Health through the experience of implementing that law. So the first thing I want to say is, when I do that, I look to the economic literature, although I'm a lawyer, I have to admit, and have a background in public health, but I still look to the economic literature because I'm trying to find information, and perhaps you can tell me where I can find this information, on what are some of the determinants that actually tell me whether or not, or guide me on, for my policymakers on what they have to do in order to build the institutions that are necessary, or the systems, the mechanisms, whatever it is. Now, to a large extent, I take my guidance from the law itself, because in most developing countries, the legal system is somewhat incomplete, let me put it that way. And that's a long conversation. So I take some of my guidance there, but I wonder if in the economic literature and in your work, you can guide me to where I can find more delineation or illumination on what are the kinds of determinants that go into creating an environment that makes sense. And I also invite anybody who might be looking for a research project to document what we're doing there, because it seems to me that it is one sector that, according to the recent World Bank report, represents up to 10 or 15% of GDP in many countries. And a good percentage of that is in the private health sector. It's spent in the private health sector. So we're talking about an economic, a chunk of the economy that's affected here. And what happens in a ministry that is not known for its knowledge of law or economics or business, they have to actually put into play something that you're doing. And in this instance, I'm always looking for the good, because I don't want the good to be the enemy of the perfect to be the enemy of the good. I need just good enough right now. Thank you.
Tim or Steve?
Well, I'm not sure I have an insight that's relevant to the very specific issue you raised, but I think it raises the question of how we go about studying this de jure de facto gap, because there is a literature, and actually I've been engaged in that, looking at how you get a more effective public organizations, more in a micro sense. Is it about incentives? Is it about selecting better quality public officials? And that's not currently part of what the Doing Business project is about, because of the focus more on the de jure, as Steve said. The question of trying to study more about effective policy delivery has been more something that's studied in education and healthcare than it has been in the kinds of bureaucracies that are involved in the delivery of the kinds of inputs to the Doing Business indicators. But there's clearly a very important part of this that we're bringing that literature together. But there is a large, just in answer to that question, there is now a large and emerging body of literature on what it takes to have more effective public bureaucracy, but I'm not aware that's been brought together with the kinds of concerns of the Doing Business project.
I'm just going to say that I'm going to hand this question to the right people at USAID, so I would love to make contact with you. I think that this is kind of a frontier issue for us at some level. Health sector is hugely important in USAID's portfolio globally. But the question posed here of effectively trying to support reforms in health service delivery and in the environment for private health service providers is still a frontier area for us. But I'd be very happy to try to put you in contact with people at USAID who can help.
Okay, thank you very much. Everyone is due a coffee break. Before we go to that coffee break, let me mention to you that the coffee break will be here, and then we have 3 breakout sessions following the coffee break, and I'll tell you that there's an embarrassment of riches that will continue throughout the conference, but I want to tell you where you would go. You have a choice of going to session 1 on market entry and innovation. That is on the 4th floor. You're on the 2nd floor right now. There are a set of stairs that will take you to the 4th floor, or there are elevators on either end of the building, so you can get there either way, but that's in room 450 for market entry and innovation. A second session on financial infrastructure, that is in the Fisher Colloquium. That is also on the 4th floor, in a very large building or room. You'll see it right away when you get to the 4th floor. And then the third session that you're welcome to attend is the Natural Resources, Entrepreneurship, and Financing from Abroad session. That also is on the 4th floor in room 415 of the Hariri building. The coffee break should be set up just outside. In closing this session, though, let me again say that I thought that it was just a terrific set of remarks. I want to ask everyone to join me in thanking Tim and Stephen.